Gold prices closed today down about 20 bucks, holding it around 1925, but ultimately taking a step back, looking at the path we've seen gold take. Last week we got as high as near 1980 and then immediately went back down to 1890. So it was a big move we saw late last week, and then early this week everything's been just kind of consolidating near the midpoint of that, right around 1925. Yesterday saw a big move higher, but a pullback today. What happened today? Well, we had a stronger than expected ADP number this morning, which typically leads to a stronger employment number, which we have on Friday. We also saw the dollar coming off. Now, a weaker dollar typically helps bid gold. That didn't happen today, but we did see Treasury yields make a significant move higher, so that may have stolen some of the allure of gold that we typically see. So gold prices right now, while they were down 30 or 20 bucks on the day, still remain elevated, still kind of in that upward sloping trend. Going back over the last few months, gold prices have seen a roller coaster ride over the last week or so, but continue to trudge forward. At this point, now kind of waiting for the Fed's next move. And we heard from Mr. Powell today, speaking to the House Financial Committee. We'll talk about that in a moment, some of the effects of his words had on the gold market. But gold right now holding near the midpoint of that big range we saw at the end of last week. And waiting for the next catalyst event to come. And who knows, it could come tomorrow. Things have been coming every day. The risk on, risk off trade continues, and we're seeing that across the board. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice there was a huge move in volatility yesterday, spike higher, taking us to levels we haven't seen since the onset of COVID, going back to the spring of 2020. So volatility clearly through the roof. When you talk about economic risks, geopolitical tensions raising, Federal Reserve risk, and obviously liquidity risk becomes an issue as well. We see prices all over the map. We see volatility moving higher. Yesterday was out of the blue. This is not typical to see volatility spike that high for one day, and so today it was lower, but it does remain elevated. So higher volatility suggests that wider price ranges are ahead, more risk clearly being priced in, and we'll have to see as the days move along how long this can continue. But ultimately, higher volatility translates into higher risk, and that's exactly what we're seeing across the board. Last, let's talk about what Mr. Powell said today in his semi-annual testimony to Congress, formerly known as the Humphrey Hawkins testimony. He basically talked about the Fed likely raising rates 25 basis points at the March meeting. Recall there was a time when there was a chance they might raise it 50. Then he talked about the strength of the economy. He talked about high inflation, both reasons why the Fed may need to act a little more aggressively down the road. And if things continue to heat up, if the economy continued to be strong and inflation continued to go higher, the Fed wouldn't be afraid to throw a 50 basis point hike out there at some point. So clearly the Fed kind of in a wait and see mode, but certainly ready to be aggressive if needed, according to Mr. Powell's words. And gold prices, while they don't necessarily like higher rates from the Fed, the higher inflation component may keep gold prices elevated, at least in the short term. So gold prices well off those extreme highs, volatility well off those extreme highs, but prices remain elevated, hovering at around 1925, the midpoint of that big rise and fall that we saw late last week.